Well, we didn't hit 6,700 last week like I was hoping, but I'm sure we're going to in July. It's just me this week. I'm looking forward to talking to you. Hi, I'm Adam Anderson, owner and founder of WealthGuard Advisors. And if you notice, Blake is not with me today, so he has the day off, but I am still here to talk to you about what's going on in the marketplace. And I'm super excited because there's a bunch of interesting facts about the month of July that I'm anxious to share with you. Let's get right into it. Hey, so I'm going to bring up my chart on the S&P 500. Yes, 6,700 was the goal for last week. We didn't quite hit it. That's the all-time high. Really thought that'd be great to do that for our Independence Day, a celebration. Not quite there. It does look like it might have been rolling down a little bit last week, but today's action, even though we got bad employment numbers that came in and gross domestic product. Remember we talked about Adam Smith economics and the wealth of nations, where our wealth is really gauged by the productivity of its citizens. And so that's why we watch so close our gross domestic production. So we want to see how much we're producing in our economy. So the numbers are a little bit lower, and that's why we also look with unemployment or employment numbers. So those also got revised down. So I thought maybe today would be a bad number because some of our productivity is not as high as we expected. So it's not about us storing gold like in the old days and in the monarchs' vaults. It's about our productivity as a society. And that's what was so beautiful about Wealth of Nations. If you didn't listen to that episode last week, go back and listen about Adam Smith economics and the revolution of 1776 that coincided with our American Revolution, changed economics in the world and in America in amazing ways. So we need to talk more about that and why that system of economics is the best. It's brought more people out of poverty and brought more wealth and more opportunities than any other system of economics. So with that being said, this week, I think before this month is out, we will breach that 7,600 again, and we will be celebrating that before the end of this month. So July has been one of the best months on record historically. We have not had a down July in 11 years running right now. It's going for the record, which is 13. I think May has that. So we could have a record again if we just close up for the month. And I don't see why we can't do that. I'm still optimistic about this market. Some people have concerns, but I still see that there is productivity that is positive. And so I'm looking forward to this July as a very good month, potentially. The average on a record, if we averaged them all out since 1991, is 1.8% for the month. Right now, we're up today, but that would, for us to get to 7,600, that's only 1% away. So good chance that we could hit it in the month of July if the trend stays. Of course, past performance is no guarantee of future results. And just because it's done 11 years in a row doesn't mean it's going to do it 12 years in a row. But I do feel optimistic about that. So last week, Blake talked to us about Amazon. And I just want to say, not that we're always right, but Blake was definitely right on this one. Look at this. In the last week, boom, almost 5% and up about 0.5% today. So we're seeing a very strong move out of Amazon. One of the things that I look for when I'm looking at a stock is high volume. And that's what this is right here. I'm also looking at these MACD converging lines. It's crossed over. That's also a good technical sign. But as far as what we call fundamentals, just the strength of the company, of course, Amazon, who doesn't know who they are, a great company. We talked about the founder story. I used to sell used college books. So great story there. But I want to talk about another company that is on my radar, and a local company from San Jose, Intuitive Surgical. And I want to show you what I kind of look for in a company. Now, the medical device industry has been down. Higher interest rates are making it so hospitals and stuff are not buying the equipment as fast as they can because leasing is or financing is not as attractive. So look at this. It used to be 600. Now we're down to 400. It's given up a third of its value in the last 6 months. pretty brutal to be holding on to Intuitive Surgical right now. But this is what I look for. One is, are their earnings good? Well, they estimated $1.60 a share, came in at $2.50 a share this last quarter. That's really good. Now on the technicals, that was fundamental light right there. But if we just kind of tap the top there, and even up to there, that line is the trend. And this last couple days, it looks like it's bucked the trend. It's broken out of it. So may still be early, but this is a good sign. And also the heavy volume, higher up day volume and growing is another great indicator that this is maybe changing trend. So if you're not familiar with Intuitive Surgical, they do the Da Vinci robotic arm. You're talking to your doctor, you're looking at a hospital, and they're talking about robotic surgery, and they're not talking about it there in the Stone Age. But this is the Da Vinci robotic arm, and it has revolutionized surgery. That's why people are leaving after major surgeries the same day. It's because of robotic surgery. I've got to use one of these machines. It's really cool. You're looking at a big screen and you're cutting a little tiny section, little tiny cauterizing knives, little cameras so you can see up in these veins. Really beautiful, amazing stuff that they're doing that's changing people's lives in amazing ways. So that's one thing that I'm looking at. It's on my radar is Intuitive Surgical. Now I want to talk about the WealthGuard philosophy because Blake and I talk a lot about individual stocks, and that's mainly because that's interesting to people. But really, for most of our clients, we have a large portfolio of bonds. Blake is actually a very active bond trader, and that a bond is a loan. You're lending your money to somebody and you're getting a fixed interest rate back, and you got a guarantee of your principal as long as the company's solvent or the government's solvent. It does go insolvent. You have the right to claim that money. It's just like going to a bank and putting it in a CD or something like that. Maybe not the same guarantees, but it could be as good as the CD or better if it's a treasury bill from the United States government. So there are degrees of safety in that. So normally when we build a portfolio, I look at it as like a pyramid. And the bottom part of the pyramid is your fixed income. And this is where the spigot would be, where you're taking money out of, is your safest, that bottom layer. And that's usually fixed investments like cash, bonds, treasury notes, things of that nature. We don't do a lot of annuities here, but that might fall in that category. The next would be diversification and having a stock equity portfolio, which most people do, diversified among a lot of different assets is what we are looking at in that second tier of this pyramid as we go up the chain and more risk, away from risk being low risk to high risk. So if you want to reduce risk, you diversify. You still want the stock opportunities, but you want to have less risk, you diversify. But if you want to grow your money, you need to be more concentrated and focused. So at the very tip of my pyramid I've created here is our more speculative types of assets. And so that would be your individual stocks. And if you're buying individual stocks, you got to know why you're buying it. You got to have an exit strategy. So you can't just buy and hold. You have to have a strategy to get out. So normally we have like a stop loss strategy. We watch it very close. We try and vet companies that we feel have the potential to do better than the stock market. So when we're diversified and we're in index funds, we're really never going to do any better than average because we're in the index averages. And usually it's going to be a little bit less than that because there's internal cost to this. So you're never going to do greater than the averages in an index fund. If you want to do that, you have to be have some in this quadrant up here to help you to grow your portfolio beyond what you would get on a regular portfolio. Let's talk about some of the stocks that we've talked over the last few year that we've been doing this. Let's talk about Eli Lilly. Obviously, since their last earnings, have done way better, up 40%. Let's look at it over a 5-year period. Of course, GLP-1s have made it so that this, besides all the other things they do, 350%, doing way better than the index or averages. So was it a clean route? No, of course not. Look at that. Down times, up times, down times, up times. Let's look at ARM Holdings. I think we've talked about that one. Went for a dead zone, 2 years. Boom, 280%. So sometimes we have to be patient with a position, and we're looking for things that will outperform the marketplace. Anyways, we could talk about, we talked about Amazon just a few minutes ago, but let's look at that as one that, well, let's go all the way back to here to there, well, 34%, you know, maybe that's on the averages, but back here to there, if we go to the low, obviously it's going to be better, but, that's 164%. Yeah. So what is one of uh, the Mag Sevens, Magnificent Sevens? Let's look at Google real quick. Obviously, a great performer going back over a long period of time, 134% over the last 4 years. So, on average, just to revisit our overall philosophy, we are mixing an active strategy, having some more aggressive things with a more passive diversification strategy. And that helps us to have the potential for greater returns than your averages. And then as time goes on and you have performance and this starts to grow because you have great performance on that top tier, and then you cut it back to where you want it to be, and you diversify back into your bonds and your more diversified portfolios. So, does that make sense? If you feel like any of the things that we've talked about, or you're interested in knowing more about us, we're happy to meet with you on a complimentary visit. It doesn't cost anything to open an account with us, doesn't cost anything to close an account with us. We are fiduciaries. We don't make any money unless you're having us hire us to manage your account. And then if you decide you don't like what we're doing, you could always terminate our agreement because we only get paid for our time that we're managing the accounts. So, um, we are interested in in you doing well. And if you don't do well, we don't do well. So our interests are aligned. We don't sell any products. We don't promote anything other than our own personal services that we're providing, but we're not getting commissioned. So you have confidence that we're acting in your best interest. So with that being said, look at the disclaimers, do your homework, but we're here to help you. We'd love to visit with you. Give us a call. Have a great week, and we'll hopefully Blake will be back with us next week, and we'll talk to you later. Thank you.